So again, we're now going to go over payroll, NFP. We had to do a non-firm payroll. That's what NFP stand for. With unemployment, when employment rates going back up, in the United States, since the beginning of the pandemic, everybody was on unemployment. Remember back in March 2020 when this pandemic began, everybody was on unemployment. Now it's 2022, March of 2022, and a lot of people are going back to work. People are leaving unemployment. Unemployment rates are going back down, meaning the US dollar is going back up because people are going back to work. So we're going to go over this game. All right, game.
Be dictated by how much the price of oil is, by how much the price of wheat is, aluminum, and other commodities.
So I do think, there's the stagflation shock that you talk about.
Pressure is on. If somebody at the Fed says to Chairman Powell, try something, as FDR said, what exactly does he try?
Well, I think right now he tries to remain calm. So as Jonathan highlighted, the Fed is faced with some very difficult trade-offs. You've got an incredibly uncertain escalating situation in Europe that could end up dragging in the US in a more direct fashion. It's already complicating supply chains at a time of high inflation. So the Fed was planning a series of rate hikes, quantitative tightening. I think for now you keep that baseline steady, and then you watch the events unfold, and as he did before Congress, you emphasize that they're going to proceed with care, with caution. This is a fundamentally different kind of supply chain disruption than the one that was driven by surging demand. This is driven by geopolitical breakdown. And that's something that, the energy prices that consumers are about to get hit with, again, that's going to move a lot faster than any wages possibly can. So the resiliency of the U.S. consumer will be tested. As the jobs report is likely to show this morning, we're coming in strong. So, there's a pretty significant cushion of momentum to absorb this shock. But the data are going to have to tell the story, and the Fed's going to have to just be extremely careful here.
Julia, from economic history and moving over to the accounting statements of the world, there's a massive divide between New World theory, which is about the immediate, the income statement, the flows, and a more old world look about just look at the balance sheet. I think of the Swiss as iconic at that. Do we have a central bank that's about ready to be very balance sheet centric, be worried about liquidity, be worried about the quality and the valuation of global assets?
Yeah, I mean, definitely that is an input into these decisions. One of the things that gave people great confidence in 2022, despite fiscal tightening, was balance sheets, right? Strong balance sheets. We heard the Fed say it over and over again. But if these assets start getting revalued very quickly, and balance sheets look shakier. And again, it's not just the level of the prices, but the uncertainty. So the volatility we're seeing is something that gives people pause, that affects business hiring and investment decisions, that affects consumer spending decisions. So, again, calibrating this is going to be careful, but the market is going to be one of the key leading indicators. How much do financial conditions tighten is going to be something that Chair Powell looks very carefully and closely at.
Yeah, it's definitely a delicate time. It's also a delicate time with a labor market that even Jay Powell said shows signs of overheating. Julia, how much do you subscribe to this theory that's being put out there quite a bit, that the stagflationary shock, the high commodity prices, will actually push more people into the labor market, will actually increase the participation rate as people realize that they have to fund themselves more aggressively in the months to come?
Well, Lisa, we were already seeing that. So with the benchmark for January in hand, if you look at prime age labor force participation, it has been on a very nice upward trend for a year now, more than a year now. So we are seeing people come back to the labor force. And there's every reason to expect that, again, as the fiscal support fades, And yes, as inflation rises and other things, we are also seeing, the things that held people back out of the labor force getting better. The Omicron wave is behind us. We should start seeing better child care operations and availability and all of the things that we expected to see. So yes, I do expect rising labor force participation to be something, it'll be a key theme in labor markets this year. And I think all the leading indicators are there and it's already underway.
Julia, as always, thanks for being with us on Payrolls Friday. Julia Coronado there of Macro Policy Perspectives. Lisa, we were hoping at the end of this year, the back half at some point as the year grows older, these supply chain issues get better. Now we've got something else in the mix, which complicates things once again.
Absolutely. How do you factor this into a world that is changing so dramatically? This has been a shock. I mean, one thing that I've noted, and I think we can't say enough, is how much this is a game changer for so many people in terms of understanding the trajectory of economic growth. If this resolves quickly, okay, then perhaps we can go back to some of the conversations we were having before. This is a new dynamic, though.
I keep mentioning this, Tom. We've got a real lack of visibility on the outlook now, right? Given what's happened in the last couple of weeks. The Fed has got to put together some forecasts next week and put out a summary of economic projections, the dot plot, growth, inflation, unemployment, all of the above.
Their cover is to wait for the inflation report. You went through the migration up here to 7.8% and even above. But their cover on let's wait is for that inflation report on the 10th, 11th. What I would say is what we're seeing in terms of visibility, John, is what you see with a Bloomberg terminal or 100 years ago in any given war, the Napoleonic War, just as an example. You look at the markets. Here's a fact, John. Right now, I'm looking at the screen with deterioration, ruble just printing a 115 again.
We're pricing the problem in Europe. I want to be clear about that, and I don't think that's inflammatory, Tom. Euro dollar's just broke 110, 109. Unicredit's down 9.5% in Italy in a single day. Some of these banks in the last 5 days have lost a quarter of their value. Deutsche Bank right now, Lisa, down 7.4%.
You can understand why. It's not just rates that are going to remain low for longer. It's also an economic uncertainty. And frankly, every analyst we speak to says it is more like stagflation in Europe than it is in the U.S.
And John, I remember you and I having lunch at Brasserie Libre in Zurich the day that the Swiss intervened in 2015.
Euro Swiss, Tom. Are we at parity yet on Euro Swiss? Right then, now aren't we? We're not far off it. Euro dollar near session lows 109.57. That currency pair down, let's call it 1%. From New York, this is Bloomberg.
So again, as you just heard, payroll, is getting, we went over NFPs, went over payroll, non-firm payrolls. The economically, we're doing better. We're doing better since the pandemic, since March of 2020 when this pandemic first started. We're doing way better. We're back at work. Unemployment rates are going down. Employment rates are going back up. So that's good for us. The U.S. dollar is about to go back up. So we should see gold heading back down. That's why we see euro heading back down. It also has to do with the war, what's going on, with Ukraine and Russia, but also have to do with unemployment rates as well, and employment rates, and payroll going back up, and if we going into you know um, you know, June and July and August and September into wintertime, people are going back to work, and are working more and more, as they understand this is serious. This is serious, and um, we already went through this already with a pandemic, and we've seen how it affects us globally, and we're on top of it this time around. I feel like we already experienced that, and we're stronger and better and more prepared than we were when this pandemic first started off. So we're people are thriving now, and people are getting more jobs are opening. People are actually working, and as far as U.S. is concerned, we're doing great. This is going to affect us, economically as far as like price is concerned. We can see probably gas going back up. But I just wanted to go over payrolls gain. We went over payroll as you heard, so we're doing a lot better, as far as, healthcare is concerned, So I just wanted to go over that game. And I hope you like these videos, and I'll be posting a lot of more videos and a lot more content. All right, gang.